Hello and welcome to the Super Bowl edition of Murphy's Market Minute. We are 3 days away.
Yeah.
Today's Wednesday,
Yeah.
Thursday, Friday. No, 4 days. Today Wednesday. Today's Thursday.
So we are 3 days away.
We're 3 days away from watching the Kansas City Chiefs rack up another Super Bowl win and create even more haters, as if that could even be possible.
Haters and conspiracy theorists.
That's right. That's right. I actually saw a pretty cool stat. 17% of plays in which the Chiefs score a touchdown has a penalty that could have possibly helped them versus 33% for the Bills.
Really?
Yeah. So who's getting helped and who isn't?
Well, everybody will say the Chiefs.
Yeah, exactly. Exactly. But you know, what's the quote? You either die young or you live long enough to become the villain.
Damn right.
Right. So anyways, today we're going to try and condense just some key points that pertain to people's investment accounts and retirement plans down to 5 minutes or less.
Yeah. We shall see about that.
We'll see about that. And then we're going to go a lot more in depth, and we'll have another link for that as well. So pretty much the bottom line that I really want to stress to everybody might just be to turn your TVs off. There is a lot of, right, and I talked about this in another podcast we're dropping, right, that people want you to talk about change, but they don't like it when you actually do it. Okay, it's one of the 48 laws of power to preach change but enact very little of it. And I've been saying that a lot recently. So there's been a lot of volatility to start the year off, but the markets are up. And for a month and however many days it's been.
Since Trump was elected?
Well, no, just since the beginning of the year.
Oh, yeah.
Right? It's been a month and 6 days.
Yeah.
And the markets are all up over 3%, like 3.5, 3.3 or so. That's pretty stellar 1 month returns. Okay. Now it's been a volatile up and down if you look at the charts.
But that,
right.
And that's like mostly due to new administration.
Yeah.
Like market reacts to any kind of changes, like you're saying. So like these tariffs.
Threat of tariffs on pause.
Yeah, causing volatility, but that's not necessarily an indicator of like future performance in the stock market.
No, it definitely isn't. And in the longer version of the Murphy's Market Minute that we're going to be sending out, we have, to quote, one of the all-time greatest Americans, and one of my heroes that I actually got to meet and hang out and talk with when I was 17 years old. Oddly enough, right before the Kansas City Chiefs played the Steelers. And the person I'm speaking about, his favorite team was the Steelers. And I was friends with a lot of the Chiefs in high school. And so I had a Chiefs jersey and a Chiefs hat, or not Chiefs jersey, but a Chiefs coat and a hat that were covered in autographs. And so when I was on this guy's in the audience of his TV show, he came out to do the pre-TV show prep. And he's like, oh, I see we got a Chiefs fan in the audience. And he called me on down. And then I just stood there on the show stage. He didn't do any of his normal show prep. We just talked shit on each other's football teams for 30 minutes. And then he's like, oh, crap, I got to go and get ready for the show, right? And then he caught me out in the hallway and we talked a little bit more. But one of the things I loved is he would take sheets of paper and he'd talk about a stack of stuff, right? Well, we got a stack of stuff, all right? We're going to get, and it gets pretty complex, right? I mean, everything from the percentage of world GDP by country to pressures on the Fed with interest rates and on the 10-year bond yields, housing starts, consumers' sentiment, corporate sentiment, all that kind of stuff we're going to get more into. But right now I'm going to kind of let you kind of lead the conversation here with what you've outlined that you think would be good for us to talk about today.
Yeah. Well, first off, as Elliot kind of mentioned earlier, we do record other podcasts. We have a longer form podcast that's going forward. Ideally, we're going to be posting on Thursdays. This week, it'll probably come out more so Friday or even Monday. So we dive into a lot of this stuff even more in depth. And some of this stuff might be repeated information. So what we talk about here is also be talked about in the long form podcast. And in my opinion, one of the biggest things that's causing the volatility in the markets right now are the threat of tariffs. So like Trump with the 25% tariffs on Canada and Mexico that have been delayed, also the 10% universal tariff. A lot of this is causing some volatility. And if you watch enough MSNBC or CNN, all you're going to hear about is how these tariffs are be causing inflation. But I think there is some good data in here that really says otherwise. So with all these tariffs, it's estimated that effectively the amount of tariffs on all products coming into the country going to be at least 7%. But Goldman Sachs has released some data saying that they're only predicting a 0.3% increase to core PCE inflation, which is inflation minus food and energy. And that's just a one-time increase.
They have inflation. The goal of the Fed is 2.3 or so. Or not the goal of the Fed, but they stated that they felt like without tariffs, inflation would stabilize at 2.3% in 2025. And that with the tariffs, hold your breath, everybody panic, inflation will be at 2.5.
Yeah, it's like a 0.3% increase.
Now, if anybody wants to see how that plays out in their financial plan, our software, actually, you can put in any kind of inflation rate you'd like. And so we can go in and we can put 2.3, and then we can show you what 2.5 does. Nothing.
Yeah. And then in addition to that, 2025 is set to be a pretty solid year with all 11 major sectors in the stock market projecting earnings growth, which is actually better than what we've seen in the past few years. So that could be an indication of a potentially stronger stock market in 2025. Of course, there's no way to truly predict the future, as you may know.
Yeah. And so one of the things we're going to do in the longer form podcast is we're going to go through Yahoo Finance's, what do they call this? It's like a 44-slide finance deck or something.
It's like the takeaways. It's kind of got some of the good projections.
The finance chart book.
Yeah, it's got some good projections, some bad projections. It's kind of got the whole array of what could happen this year.
Yeah, and then we're also going to go through a lot of data from a company called ITR Economics out of Massachusetts. They were brought out by ACG, which is a Kansas City organization that one of our clients founded here in Kansas City. And they do the biggest economic forum every year, and they bring this company out, and they kind of talk about what's going on for the past year, what the next year and next few years is looking like. And then one thing we're going to talk, just so you guys don't, because I know I tend to always be optimistic, but one of the things that they point out is they've been predicting since 2014 that there would be a recession. And so in the longer form version of this, we're going to talk about what they mean by that. They expected it initially to hit in 2028. They do feel that due to certain things that are now taking place, that's been pushed out a couple years possibly. So now they're telling you to kind of be prepared for it in 2030. So I do want our clients to understand that we do look for these kind of events to occur. We know that they do. They occur every so often. And we specifically try to design plans to be able to deal with that. And then we specifically also watch the markets as to when to make changes due to those things.
Yeah. And most of the podcasts we're doing, not investment advice, but it is like a good, just a good point to.
I just talk about like what the risks are to the overall market. We never tell people what to buy.
Yeah.
Or when to sell.
Yeah, we're not telling you what to buy, what to sell, but it is good to, go ahead and diversify a little bit. That's really what, if you're getting close to retirement, keep you safe.
Yeah. So the Yahoo chart book, they start off with, I think, a pretty cool little intro to it. So we had the best 2-year stretch in the S&P 500 since the late 90s. Very few people are calling for that to end. And there's a lot of this optimism they feel is going to basically, it's the key narrative. All right. And then let's see what else they talk about.
Yeah, and I think another cool piece of data that goes in with that is that we have had a couple really strong years with S&P 500, and something to keep in mind on is that typically bull runs in the market that have gotten past that 2-year mark have historically lasted quite long.
Yes.
So this is there's been 5 other in the last 50 years. There's been 5 other bull runs lasting over 2 years, with the shortest one being 5 years and average being 8. So that kind of aligns well with like maybe push that back 2030 or so.
Yep.
Could be later, could be sooner.
Yeah.
We really don't know. We don't have a
No,
magic ball.
but one of the things I like about this data firm is that they take, they didn't just make a prediction in 2014 and then like lock that in and say no matter what happens, right? The future's unknown.
Exactly.
I don't think a lot of people could have imagined what happened politically in the last year to have occurred. I don't think anybody could have seen the last 3 weeks coming.
Yeah.
And so all of that just shows that, yes, the future is unknown. Their prediction could occur sooner, it could occur later. And they even talk about how the things are so optimistic right now that actually has become the fear, that optimism is running too high, right? So anyways, yeah.
Well, what shall we?
Well, here,
What's
so
the next chart?
yeah, so let's just keep going with the bull market, right? Binky Chadha from Deutsche Bank is their chief global strategist. All right, and I probably should have Googled whether Binky was a his or her or Zer or Zag or
It's one of them.
it's one of the 72 genders there. But this person, they, them, said that the current economic context is strong and rare. The present combination of low unemployment and strong GDP growth has only occurred 6% of the time historically. Prior such episodes occurred in the 65 to 69 in the second half of the 90s. Each saw very strong equity market performance. Yeah. All right. So, like, I have some people, I make a joke that depending on who's elected, depends on which half of my clients I got to talk off the ledge. And so right now you can all imagine the half of my clients I'm having to talk off the ledge. So, their title of this slide is A Strong and Rare Economic Backdrop. All right. And they have additional information that goes with it, right? One of the things that we saw over the last couple of years is the Magnificent Seven were leading the way. And they said that's starting to shift, and that these other companies on the S&P 500 and the NASDAQ are also starting now to perform, right? And so again, we're coming into this period where it's like, a rising tide lifts all boats, right?
Yeah.
Richard Bernstein from Advisor, he's the Advisor CEO and Chief Investment Officer, said that we think 2025 will be the year of returning to normal, broader markets. So I just think that, if you're worried about your money, right, I don't know that now's the time to be worried about it.
Yeah, because I know with that chart they're talking about how 2024 was one of the historically most narrow margins in the stock market, meaning that like a very few select companies actually outperformed the market, and so they're projecting that should kind of even out to where more companies are, it's more level. So it's like maybe closer to 50-50 outperforming, underperforming.
Yeah.
And then obviously the average of the market.
Yeah. Yeah. And then another narrative that I heard a lot, and I've commented on this probably last year at some point, was just that stocks are overvalued. Okay. And I'm like, well, you could say that based on their price to earnings ratios, maybe they're overvalued. But again, inflation affects everything, right? So if I dump a ton of money into the market, now you have more money with which to buy everything. Well, that's going to create an overvaluation of stock price, but is it really overvalued in comparison to the money supply?
Yeah.
Right. And so, one of the things that Goldman Sachs is talking about is that stocks aren't really that expensive.
Yeah.
Right. That while multiples today appear expensive when compared with historical averages, these valuations are supported by the strength of the current macroeconomic and corporate fundamental environment. So he says that taking those factors into account, the multiple of the U.S. equity market is almost exactly in line with fair value.
Yeah, because a lot of people who kind of look at surface level stuff, they might look at the stock market or individual stocks and look at something like the price to earnings ratio, and as that ratio gets higher and higher, stocks appear more and more expensive. But you have to factor in things like the earnings growth. Like if companies are projecting higher earnings, to grow, the earnings from this year to next year is going to grow 10, 20, 30% over the last year. That's when investors are willing to pay a higher price. So the price to earnings ratio, I think companies like NVIDIA are a good example of that.
Yep.
The price to earnings ratio might seem high compared to stocks that maybe aren't a tech stock. But the reason why they are priced that way is because of the projection, like their earnings projections being higher than last year.
Yeah.
So that's all kind of factored in, and that's kind of what Goldman Sachs is saying, is that really they're in line with their fair value.
Yes, yes. And I think something else that factors into this is what a guy named Cam Harvey from Duke University talks about. He's talking about the end of the boom and bust era, right? And he said there's good reasons to believe the U.S. business cycle has become less volatile. And he goes from 1880 to 1920 as the developing country, the U.S. had 12 recessions, all before the Great Depression, and was in recession 44% of the time.
Yeah, nearly half.
Yeah, right, which is crazy.
Absolutely
I mean, I didn't know that.
Yeah.
You only ever hear about the Great Depression.
Yeah. And then in our, like, certainly my lifetime and even your lifetime, like the percentage of time that we're in a recession is far, far less than 44%.
Oh, absolutely right. And he said, so in the last 40 years, the U.S. has only endured 4 recessions. One was big, 2 were trivial, and 1 was brief. That was COVID.
Yep.
And recessions have occurred in only 8% of the quarters. Right? That's an. I mean, there's just so much to be optimistic about. Right? There's so much positive things. That's why I am so optimistic.
Yeah.
So.
And I think ultimately, the media is created to sow fear into the country.
Yeah, FUD.
And
so fear, uncertainty, and
yeah.
doubt.
And so, these 4 years, you're watching liberal media, they're going to be telling you the world's ending. Last 4 years, you watch Fox News, the world's ending.
Correct.
And then
guess what?
After 2028, one of the sides are going to be telling you the world's ending. And then this time, 30 years down the line, like, we're going to be just fine.
And the world didn't end with Nixon, Reagan, Clinton, Obama. Well, Clinton, Bush, Obama, Trump, Biden.
And then
the
Trump
odds
again.
are, I'm just going to take a wild guess, it's not going to end under Trump 2.0 either.
Yeah, probably not going to end. And this time in 4 years, all the stuff we're talking about the market's going to be much higher than they are today.
Absolutely. And so, and just to further shore that concept up, right? And I've talked a lot about this over the last few years because Americans' balance sheets got really, really good within the last 5 years. And even coming out of COVID, where they're at their peak because of all the government, all the money the government dumped into the system. According to Bank of America, household balance sheets remain remarkably robust despite concerns about the depletion of excess savings. The ratio of total assets to liabilities is at an all-time high.
Yeah.
The ratio of liquid assets to liabilities is 10 percentage points higher than it was pre-pandemic. So what does that tell you about the health of the U.S. consumer? We're in a consumer-based economy, right?
I mean, it's a good thing. It's just like a company having a stronger balance sheet is can be seen as a good thing. Definitely for individuals, that's just showing what you own versus like what you owe. So instead of like having credit card bills, car payments, bigger mortgage, they're actually owning more of that investments.
That's incredible, right? Now, in addition to this, labor productivity is growing above pre-pandemic rates as well, right? Somebody named Claudia Sam says labor productivity growth picked up in the past 2 years and is running above its pre-pandemic pace, and the rate is the U.S. And above the rate in the U.S.'s peer countries.
Yep.
And that's another thing too that this economic forum talked about was just U.S. exceptionalism. How the S&P 500 created a huge gap between its performance in the last couple of years and, say, EU's or Japan's, definitely China's. And our labor productivity is growing faster than these other countries. I mean, we are what we have always been, right?
Yeah, and the labor productivity, part of the reason why something like that is like a good thing to have more productive labor is because that's what ultimately will decrease like the cost of like wages, which sounds bad, but like for these tech companies that are growing so fast, this is a good thing because they're spending less on like payroll and more into investing in growth, whereas more retail sectors are going to have much higher cost of labor.
Yeah. And so, I mean, we've probably gone quite a bit of time. I don't know if you have more stuff on that list you want to do, or I want to leave you with one thing to wrap this whole thing up if we're approaching the end. I hate to end on a negative, but the federal debt forces the government to create more money, right? We're projected to run a $1.9 trillion deficit in 2025. And we have this chart, and I don't know if we're going to be able to include these, but defense spending is 14% of the federal budget. Interest is 15% of the federal budget. So one of the two things that the federal government is explicitly tasked with in the Constitution, which is the defense of this country, we are spending less money on than we are on interest payments to our creditors. Mind-blowing.
That's something that's growing.
Yeah. I would like to see bumper stickers that say, how about we spend more on education than we do on interest on debt? That'd be a great bumper sticker.
I would agree.
Right? We are literally like, you add non-defense discretionary spending with our defense spending. All other spending are social programs. You get 26% of the entire federal budget is defense spending and non-discretionary and discretionary non-defense spending. That's the only stuff that's argued about, debated, voted on. 26% of the federal budget. The entire remaining 74% of the federal budget is Medicaid, interest, Medicare, Social Security, and then 12% are a bunch of other miscellaneous social programs.
That's going to be something that at some point will have to be changed. And like you said, one of your quotes where you're saying, like, talk about a big change and act very little. I feel like that's something our government has done for quite a while. And it's pretty clearly, I'm not going to be president one day, but it's pretty clear that those social programs are what are going to be a very long-term risk for our country. That's really what's driving this deficit up and up, higher and higher. And that 15% that we're paying on interest payments is only going to get bigger and bigger as we keep continuing to drive up this deficit every single year.
Yep.
I mean, I think we get so used to hearing these numbers, millions, billions, trillions,
Yep.
that we kind of lose the sensitivity to how big of a number that is. But $1.9 trillion in 1 year deficit is absolutely absurd. And I think another thing, not to get too political, but looking at something like that Department of Government Efficiency, you hear all these line items that we're wasting money on, like overseas or domestically, that are just completely ridiculous. I'm not going to get into any specifically, but you hear the number saying it's like 50 million, 100 million, maybe like 2 billion. And compared to $1 trillion, those might seem small. But I think at a certain point, people have to get back to reality and realizing how much money, even those tiny, what we call tiny programs, how much money that really is. And do we really need that?
Yeah, so here's one for you. So if you converted $1.9 trillion into years, with $1 being 1 second.
Oh, goodness.
So you got to spend $1 a second.
What is it?
How long would it take you to spend $1.9 trillion spending $1 per second?
A long freaking time.
60,206 years. 60,206 years spending $1 per second.
And at some point, I know in the longer form podcast, we've talked about it, like when is it actually unsustainable? I think we're on the track of that. I mean, it's hard to say when that will ever be.
Yeah, you're spending $31,557 million per year.
Yeah. And I just think every step that can be taken to trying to reduce that deficit per year is an important step. And I just think many Americans have become too desensitized to how enormous these numbers are.
Oh, absolutely. And so just to wrap this up with a little anecdote, I've learned and grown and gone through a lot of changes in business. And at the end of last year, Alpha had grown to like 38 employees and 4 offices, and we were running negative every month. And I would go to my people and I'd be like, hey, we can't afford, we need a cut. We cannot afford this. And all I ever got back was, well, you can cut $2,000 here or $5,000 here. And I'm like, yeah, no, that is a drop in the bucket. That's not helping. And I even looked at them at one point and said, you either do it now in a controlled manner, or it's all getting wiped out in an uncontrolled manner later. Those are the only 2 options, right? And so in February of this year, because of my failures as a leader to get the controlled cuts done that needed to happen, I went from 38 staff to now 5, right? So all the lies about how we couldn't cut were just that, because I got news for you. When reality comes face to face with it, what has to happen? Cuts, right? And we talked about this yesterday in a long form podcast. It's like you can sit there and tell me all day long how necessary something is or how important something is, but these federal programs never scale their budget back. It's just constant growth. It's constant hiring. It's constant expansion of budgets.
Yeah, you never see that actually shrink.
No.
Everybody's competing with each other for their little share of that budget.
Yeah, and there's nothing wrong with contracting at times, helping you get more lean. Right? Getting more efficient, getting more creative. There's nothing wrong with that. It's a natural part of a normal business cycle. And it's a natural part of a normal human development and growth, right? And so that is the only thing that and I don't know how much it matters. I just wanted to talk about it because I had the slide here.
Yeah, and that's definitely more of a long-term problem.
Yeah.
But like you said, it's like either controlled change now or uncontrolled later. And I think it's something that the future of our country, the future of the people of our country should be taken into consideration and weigh that out versus the cost of these programs that we're doing now. Even programs that might seem to help people in the present might not be sustainable down the road.
Yeah, so to kind of sum it back up and put this all into context, right? What did we talk about? We talked about how we're 2 years into a bull run. The shortest bull run lasted 5.
Yeah.
So there's
Average of 8,
right? So there's 3 to 8 more years coming. We are paying attention to certain risk factors like the debt that are going to start to cause us problems around 2030, most likely. There's massive optimism. The stock market is starting to broaden, which is wildly beneficial for everybody. We're outpacing every other country there is. And
I also think all of what MSNBC and CNN might be saying about the inflation that Trump's going to be causing is much more minimal than what they might claim.
Yeah, 3/10 of a percentage point or 30 bips if you're in the financial world. I assure you, you're not going to notice that. So things are looking pretty good. They're looking really well for our portfolios, for our retirement plans. If you have any questions about any of this specifically, we'd love to get more in depth into it. Feel free to call us up, set an appointment, talk to Abby. So super, super long. We absolutely failed again at our 5 minutes.
Yeah, we were, about way off.
Way off. But we're going to get more disciplined. And maybe we'll just edit this to 5 minutes of an opening and tell you got to watch the rest of it. I don't know.
Yeah, I don't think we're ever going to get this down to 5 minutes. So.
All right. So go Chiefs. Let's get that third back-to-back Super Bowl.
Amen.
And everybody have a wonderful weekend.
Yes, ma'am.
This is Elliot. Sign off.